Breaking Japan's Nikkei 225 has just smashed through new all-time highs, levels not seen since the legendary 1989 bubble. But here's the twist. This time it's not banks, not real estate. The real driver is semiconductors. Today we'll uncover three Japanese champions, Tokyo Electron, Screen Holdings, and Shin-Etsu Chemical, that are quietly powering both the Nikkei and the global AI revolution. To understand why Japan's new highs in 2025 matter, we need to go back to history, back to the late 1980s when Japan was the hottest story in global finance. In 1989, the Nikkei 225 reached an astonishing 38,957 intraday and closed at 38,915 on December 29. This was the peak of what the world remembers as the Japanese asset bubble. At that time, the drivers were not semiconductors or technology. They were banks, insurance companies, and real estate developers. Easy credit policies and loose monetary conditions flooded the market with money. Banks lent aggressively, often using real estate as collateral. Property prices in Tokyo went completely insane. One famous phrase summed it up: "The land under the Imperial Palace in Tokyo is worth more than all of California." That statement, while exaggerated, captured the global perception. Japan's land and stock values seemed limitless. Major developers like Mitsubishi Estate, Sumitomo Realty, and financial giants like Nomura and Daiichi Kangyo Bank became symbols of unstoppable wealth. Share prices surged not because of sustainable earnings growth, but because everyone believed the party would never end. But the party did end. In the early 1990s, the Bank of Japan tightened policy. The bubble burst, stocks crashed, land prices collapsed, and Japan entered what became known as the Lost Decade. In reality, it was more than a decade, nearly 30 years of economic stagnation, deflation, and investor disappointment. During this long winter, Japan's stock market became a warning to the world. Beware of bubbles built on speculation. Even as global markets boomed in the 1990s with the internet revolution, and again in the 2000s with China's rise, Japan remained stuck. But quietly, something else was happening beneath the surface. While Japan lost its leadership in consumer electronics and memory chips to Korea and Taiwan, it held on to world-class strengths in semiconductor equipment and materials. The global public didn't notice, but Japanese firms continued to supply the essential tools and chemicals that every chipmaker needed. Fast forward to 2025. Today the Nikkei has broken above 45,000, leaving the bubble-era highs behind. This time the drivers are very different. Instead of banks and real estate, the heavyweights pushing the index are technology and semiconductor-related names. Companies like Tokyo Electron, Screen Holdings, Shin-Etsu Chemical, and also testing and optics firms like Advantest and Lasertech. Why? Because global demand for chips is now structural, not speculative. Analysts project the semiconductor industry could exceed $1 trillion by 2030. AI data centers alone are expected to triple their electricity consumption by 2034, creating massive demand for efficient chips. Electric vehicles require 2 to 3 times more semiconductors than traditional cars. And here's the crucial point: Japan is not trying to compete with NVIDIA or TSMC directly. Instead, Japan provides the backbone, the equipment, the wafers, and the chemicals that make all global chip production possible. So when you see the Nikkei at record highs today, understand this. In 1989, Japan's highs were built on banks and land, unsustainable speculation. In 2025, Japan's highs are built on semiconductors and global demand, structural, durable, and indispensable to the digital future. First, Tokyo Electron, the gatekeeper of lithography. To understand Tokyo Electron's power, let's first walk step by step through how a chip is made. Every semiconductor starts with a silicon wafer, a thin mirror-like disc sliced from a single crystal of silicon. This wafer is the canvas. Without it, there is no chip. The process of building a chip is like constructing a skyscraper, one microscopic floor at a time. Engineers deposit layers, draw patterns with light, etch them into the material, and then repeat the cycle hundreds of times until billions of transistors are packed onto the wafer. Let's break it down. Step 1. Coating. A wafer is coated with a light-sensitive chemical called photoresist. This thin film is just nanometers thick, but it is critical. It decides where circuits will and will not form. Step 2. Lithography. Light, projected through a mask, exposes patterns onto the photoresist. This step is dominated by ASML's extreme ultraviolet lithography, or EUV, machines from the Netherlands. Step 3. Developing. Just like in old photography, the exposed parts of the photoresist are dissolved, revealing a precise pattern. Step 4, etching and deposition. In etching, unwanted material is removed. In deposition, new material is layered on. Step 5, cleaning. After each cycle, the wafer must be cleaned at the atomic level because even a single particle of dust can ruin the chip. This cycle repeats: coat, expose, develop, etch, clean again and again until the chip is finished. Now where does Tokyo Electron come in? Tokyo Electron, or TEL, dominates coder developer systems. These are the machines that apply photoresist onto the wafer and then develop the pattern after exposure. TEL systems are not glamorous like ASML's EUV, but they are indispensable. Without perfect coding and developing, lithography itself fails. TEL's global market share in this field is estimated at over 80%. Some analysts say closer to 90%. That is an extraordinary choke point. Every advanced fab in the world, TSMC in Taiwan, Samsung in Korea, Intel in the US, relies on TEL. And TEL is not limited to coders. It also makes equipment for etching, deposition, and cleaning. This diversification allows it to capture revenue across multiple steps of the process, but its dominance in coder developer is its crown jewel. Financially, TEL is a powerhouse. In fiscal 2024, it recorded revenues of about 2.2 trillion yen, operating margins around 25%, and return on equity above 20%. These are world-class numbers, rivaling its American and European peers. Investors also appreciate its discipline. Consistent dividend hikes and share buybacks make TEL a shareholder-friendly name in a market where not all Japanese firms have the same focus on returns. Strategically, TEL is Japan's answer to ASML. ASML may control the EUV lithography tool, but TEL surrounds it with the coding and developing equipment that make EUV usable. In other words, ASML may be the king, but TEL is the gatekeeper. Without Tokyo Electron, advanced chip fabs cannot function. And that makes TEL not just a Japanese champion but a global backbone of the AI age. Next, let's talk about a company that almost no one outside Japan has heard of, but that every chip in the world depends on: Screen Holdings. Screen is a specialist. Unlike Tokyo Electron, which covers multiple areas, Screen focuses on just one critical process: cleaning wafers. Why does cleaning matter? Think about how small transistors have become. At 7 nanometers, 5 nanometers, and now 3 nanometers, the circuits on a chip are only a few dozen atoms wide. At this scale, a single particle of dust, a tiny scratch, or a leftover chemical residue can destroy an entire circuit pattern. If one transistor is ruined, the yield, the percentage of good chips per wafer, drops and costs skyrocket. That's why cleaning is not optional. It happens over and over again during the chip-making cycle. After deposition you clean, after etching you clean, after ion implantation you clean. Industry experts say wafers go through hundreds of cleaning steps before they leave the factory. Screen builds the machines that make this possible. Its portfolio includes single wafer cleaners, batch immersion tools, and spin scrubbers. These machines blast wafers with ultra-pure water, chemicals, and carefully engineered flows of gas to remove contaminants that the human eye could never see. In this niche, Screen is a leader. Analysts estimate its market share in certain categories at 30 to 40%, often ranking number 1 or 2 globally. Competitors include Lam Research in the United States, which is larger overall but less dominant in cleaning. Screen wins because it has spent decades refining one specialty. Financially, Screen is smaller than Tokyo Electron, with annual revenues around 450 billion yen and margins close to 20%. But don't let the size fool you. Its customers are the same giants: TSMC, Samsung, Intel, and they cannot operate without Screen systems. And as technology nodes shrink further, Screen's importance actually grows. At 2 nanometers, 1.4 nanometers, and beyond, contamination control becomes exponentially harder. That means more cleaning cycles, stricter requirements, and greater reliance on companies like Screen. From an investor's point of view, Screen is a hidden gem. It doesn't have the name recognition of Tokyo Electron or ASML, but its business model is tightly tied to the industry's most advanced roadmaps. When chipmakers push forward to the next node, Screen's order books fill. So while Screen may be smaller in scale, it holds an irreplaceable niche. It is the quiet workhorse of the semiconductor supply chain. Without constant, flawless cleaning, there is no yield. Without yield, there are no affordable chips. In short, Screen doesn't just wash wafers, it keeps the entire semiconductor industry running. Finally, Shin-Etsu Chemical is the #1 silicon wafer supplier worldwide, with over 30% market share. Together with Sumco, Japan controls more than half the global wafer market. Let's pause and think about wafers. A silicon wafer is like the blank canvas of every semiconductor. Without wafers, there are no chips, no AI processors, no smartphone SoCs, no automotive sensors. Producing wafers is an art and a science. First, engineers grow a perfect single-crystal ingot of silicon, often more than a meter long. Then, they slice it into ultra-thin discs with diamond wire saws, polish them to atomic-level smoothness, and clean them so thoroughly that not a single defect remains visible under advanced microscopes. This process is incredibly capital-intensive. Plants cost billions of dollars. The technical know-how is guarded like state secrets. Very few companies on Earth can do it at scale, and Shin-Etsu is the biggest. The company's long-term contracts with TSMC, Intel, and Samsung provide stability. Unlike equipment makers, which can see revenues swing 30% year to year, wafer suppliers enjoy steadier demand. Every fab needs wafers, in good years and bad. Financially, Shin-Etsu is enormous. Revenues exceed 2.5 trillion yen, with strong margins. It is also the global #1 in PVC, and it has strengths in photoresists and rare chemicals, providing further diversification. For investors, Shin-Etsu offers something rare in semiconductors: stability. Equipment makers like TEL may soar or crash depending on the cycle. But Shin-Etsu keeps selling wafers year after year, riding the industry's long-term upward trend. If Tokyo Electron is the gatekeeper and Screen is the cleaner, then Shin-Etsu is the foundation itself. No wafers, no chips. And without Shin-Etsu, there is no global semiconductor industry. Risks and lessons. What 1989 can teach us about 2025. It's easy to get carried away with excitement. The Nikkei is at record highs and Japan's chip makers are world leaders. But let's step back and look at the risks. First, cyclicality. The semiconductor industry is notorious for booms and busts. Capital spending on equipment can swing 20 to 40% from one year to the next. A sudden slowdown in smartphone or PC demand can ripple through the whole supply chain. Second, geopolitics. The US has imposed strict export bans on advanced equipment to China. For companies like Tokyo Electron, which sell heavily to Chinese fabs, this is a real headwind. China accounts for about 30% of global semiconductor demand. Third, currency risk. Many Japanese companies earn revenue in US dollars but report in yen. When the yen strengthens, profits get squeezed. Fourth, competition. ASML dominates EUV lithography. Applied Materials leads in deposition. KLA controls process inspection. Japanese firms are world-class, but the competitive landscape is fierce. So could this be another 1989 bubble? Let's compare. In 1989, valuations were driven by land speculation and financial engineering. Companies were worth astronomical sums on paper, but earnings didn't justify it. In 2025, valuations are rising because of structural global demand. AI, EVs, data centers. These are not speculative fads, but megatrends reshaping the global economy. The lesson from 1989 is clear. If valuations detach from fundamentals, collapse follows. But this time, fundamentals are real. Downturns will still happen. Semiconductors are cyclical. But the long-term foundation is strong. In short, 2025 is not 1989. Then, Japan built castles on sand. Now Japan builds the foundations of the digital future. So far we've looked at history, at risks, and at individual companies. But to really see the big picture, we have to ask, what makes Japan's semiconductor role a long-term opportunity, not just a short-term rally? Let's begin with AI. Artificial intelligence is the hunger engine of the chip industry, training large language models, running inference across billions of queries, powering autonomous systems. All of this requires enormous compute. NVIDIA GPUs are the stars of this show, but those GPUs cannot exist without advanced wafer substrates, photoresists, and fabrication equipment. And who supplies those? Japan does. Every time you hear about ChatGPT or an AI supercomputer, remember, somewhere in the background a Japanese machine coded the wafer, a Japanese cleaner scrubbed it, and a Japanese chemical company supplied the silicon itself. Next, electric vehicles. An EV uses 2 to 3 times more semiconductors than a gasoline-powered car. Power management chips, sensors, ADAS, infotainment, all of them increase silicon content per vehicle. With automakers from Toyota to Tesla to BYD going all in on electrification, the semiconductor demand from cars alone is set to explode. Third, data centers. Japan's Ministry of Economy, Trade and Industry projects that domestic chip demand could double by 2030 as data center capacity surges. AI data centers in particular are expected to triple electricity consumption by 2034. That means new fabs are not optional, they are essential to meet demand. And this is where policy enters. Governments worldwide have woken up to the strategic importance of chips. In the US, the CHIPS Act; in Europe, the EU CHIPS Act; and in Japan, subsidies exceeding 10 trillion yen are being mobilized to restore domestic chip capacity. Two projects stand out. First, TSMC's JASM plant in Kumamoto. Backed by Sony and Denso, this fab began with a plan to produce 22-28 nanometers chips for automotive and industrial use. But demand was so strong that a second fab is already under construction, targeting 6-7 nanometers nodes. Together, these plants are expected to exceed 100,000 wafers per month. Second, Rapidus, Japan's national champion project with IBM. Rapidus aims to achieve 2 nanometers mass production by 2027 in Hokkaido. It is a bold, high-risk bet. But if successful, it will put Japan back at the leading edge of logic manufacturing for the first time in decades. Now combine these pieces: AI supercomputers, EV adoption, exploding data center demand, government subsidies, new fabs like JASM and Rapidus. All of them point to one thing: Japan is not just back in the Nikkei index. Japan is back as a critical technology hub for the world. In 1989, Japan's market highs floated on banks and land. They were castles built on sand, spectacular but fragile. When the bubble burst, those castles crumbled, and Japan endured decades of stagnation. But in 2025, the story is different. Today's rally is not about empty speculation. It is about demand. Demand for artificial intelligence. Demand for electric vehicles. Demand for data centers that power the digital economy. And at the heart of that demand, you will always find semiconductors. Not just the chips designed in Silicon Valley or fabricated in Taiwan, but the essential infrastructure supplied by Japan. Think of the chain: a silicon wafer from Shin-Etsu, coding and developing by Tokyo Electron, cleaning by screen, layer after layer, cycle after cycle, until a chip emerges, ready to drive AI, to power an EV, to fuel a data center. Without Japan, this chain breaks. Without Japan, the AI revolution slows. Without Japan, there is no digital future. And this is the real meaning of the Nikkei's record highs. They are not a replay of 1989, they are a new chapter, one built not on illusions, but on foundations the world desperately needs. Tokyo Electron, Screen Holdings, Shin-Etsu Chemical. They may not be household names, but they are the backbone of the AI age. Remember, without Japan, there's no AI. Semiconductors are cyclical, capex swings can be brutal, geopolitics add friction, export controls limit what can be sold to China, and no one outruns ASML at the bleeding edge. Lesson from 1989, valuations detach when stories outrun cash flows. The difference today: chips are inputs to everything. AI data centers, EVs, industrial automation, the use cases are real. Multiple independent sources still see a $1 T-chip market by 2030 if investment continues. 3 dashboards for investors: orders and WFE spend at leading fabs, signals for TEL screen, wafer ASPs and utilization, signals for Shin-Etsu's margin mix, policy and projects, JASM ramp cadence, Rapidus milestones, and any new subsidies or export control shifts. In 1989, Japan's market highs floated on banks and land, and collapsed. In 2025, Japan's new highs are built on chips and real demand. Tokyo Electron, Screen, and Shin-Etsu aren't household names, but without them, the AI revolution stalls. Without Japan, there's no AI. And for more insights on Japan's market gems, follow Sakura stock.